Welcome everyone. Today we'll discuss Tata Power. We'll check if it is a renewable energy powerhouse that most of us believe it to be. We'll discuss their upcoming projects and how they can be a game changer for Tata Power. We'll also dive into its valuation along with one key metric that has kept the stock subdued. We'll also look at the biggest issue that the company is facing and how it can resolve this issue. We will end with a short overview of the biggest threats to the company's future. First, let us understand the company well. Tata Power is not just a power generation company. In fact, less than half of Tata Power's revenue comes from power generation, while the majority comes from transmission and distribution. It is also less renewable energy focused than most of us believe. Only 16% of its revenue comes from renewable energy, while 32% comes from thermal power. Still, in terms of renewable energy, Tata Power is aggressively expanding its portfolio, including solar, wind and hydro projects. The Bikan-Neemrana project especially, which was acquired in December 2024. Tata Power won the bid to acquire this project, which will help evacuate 7.7 gigawatt of renewable energy from the Bikan complex in Rajasthan. When I say evacuate, this means it is not a power generation project, it is a transmission project. And for those in the know, transmission is the bigger issue for the power sector. The Institute of Energy Economics finds that somewhere around 50 gigawatt of renewable power in India remains stranded because of transmission bottlenecks. This is a huge opportunity that Tata Power must benefit from to create more upside in the stock. The Bikan-Neemrana project in particular has the potential to add about 20,000 crores to Tata Power annually. At a net margin of 10%, that is about 2,000 crores added to Tata Power's profits. At current price to earnings, that is about a 40% upside for the stock once the project is completed, which should take 2 to 3 years. There are other smaller projects that should add incrementally to Tata Power's business. The idea though is that Tata Power's growth prospects are currently very strong. The question then becomes, why has the stock been consolidating for the past year while the likes of Adani Power have reached new all-time highs? Well, there are three main concerns with the company's financials. The company's ROCE, return on capital employed, valuation and debt. Tata Power's return on capital employed is about 11%, which is nearly the same as its cost of capital. Usually, return on capital employed must be greater than cost of capital. Common sense. If you're raising money at 11% interest, then you should make 15 to 20% on it to be profitable. For Tata Power, this basically means that the company isn't really making money on new capital. It is barely breaking even, primarily because of one financial burden. In terms of valuation though, their P is about 30, which is high for power sector, and their price to book of 3.4x is also very expensive. For comparison, only Adani stocks are trading at higher price to book values than Tata Power. Most importantly though is the company's debt. The company has 58,000 crores in clear debt along with other liability items of 30,000 crores. That's about 90,000 crores in debt for a company making 5,000 crores in annual profit. In fact, the interest cost on this debt is what makes Tata Power less profitable. They spent 5,000 crores in interest cost last year. If they didn't have to pay this, their profits would have doubled along with the stock's price. Now, with this level of debt, any slowdown would hit the business very heavily. And that risk is perhaps the biggest reason behind the stock's lackluster performance. As I always say, high debt is high risk. Now, how can the company handle or reduce its debt? Well, the company argues that most of this debt is for capex, so this debt would naturally be paid off in time using the cash flow from these new businesses. But how long will that take and how much extra profit can Tata Power really create? The company is trying to increase its renewable capacity from 5 gigawatt to 20 gigawatt in the next 6 years. So, it will take time. That would double Tata Power's total power generation capacity though, and profits should see a spike. However, for a stock trading at a 30 times price to earnings, that alone might not be enough. So, Tata Power is also working on an ambitious rooftop solar project using which it plans to add another 10 gigawatt of total capacity. This is further complemented by its EV charging stations. Tata Power already has 5,500 EV public charging stations, 1.4 lakh home charging stations and are heavily planning to expand on this. They are usually profitable businesses with strong free cash flows, so this could be a cash cow for the future. Using all of these projects, Tata Power targets 10,000 crores in net profit by 2030. That is easily doable even with the high interest costs. However, at current market cap, Tata Power would still be trading at 15 times price to earnings at that point. Not exactly cheap for a power company. The key is if Tata Power can manage to reduce its debt, reduce its interest cost while achieving a 10,000 crore profit. If it can do that, the stock would then look extremely cheap. That could trigger the next leg of re-rating, debt reduction. And there are three reasons why it's likely to happen. Cash flow from new operations should generate a surplus to help reduce the debt. We are already in a falling interest rate environment, so Tata Power's interest cost would naturally fall as the RBI reduces borrowing rates for everyone. And Tata Power's strong credit ratings also allow it to refinance its loans at cheaper interest rates. They have already begun working on these refinancing plans. All of this combined can make Tata Power much more profitable and much more stable as a stock. If nothing goes terribly wrong, that should mean a significant rise in the stock's price. But there are some threats as well. Naturally, the cash flow from new operations is not a guarantee. Any policy changes or legal hurdles to its major projects would significantly damage Tata Power's plan. Its acquisitions are also heavily linked with the government, so any friction on that front would mean a catastrophic collapse. Its thermal business, which is still Tata Power's bread and butter, is still sensitive to margin pressure. If coal prices soar because of geopolitical tensions, for example, Tata Power's current cash cow would suffer. India's power transmission companies are also financially unstable at this point, and Tata Power is heavily exposed to them. Any major issues with payments from these companies would mean deferred or lost profits, which could be detrimental to Tata Power. With the amount of power that the major players have been adding together, we also risk overcapacity. While demand is not an issue right now, transmission already is. If transmission capacity cannot keep up with production, or if the demand for power falls, all the excess power that Tata Power is generating would just be wasted away. To sum it all up, Tata Power has ambitious plans for which it has taken on a large risk in the form of debt. If this pays off, the stock could be a multi-bagger from here. Any major policy changes, recessions, or supply chain disruptions, though, will hurt the company disproportionately. I wouldn't buy yet, but for a high-risk investor, I can see the appeal.